Hello and welcome to Beyond the Charts, a show where we dive into fascinating charts from the world of finance and the economy, breaking down what's really going on. I'm your host Kashish Kapoor and let's dive into this straight away. By the way, to view all the charts and sources discussed in this video, do check out our newsletter. You can find the link in the description. In the last episode, we talked about what's going on with the US economy. Today, let's shift our focus to the Eurozone. First, a bit of background on the Eurozone. It's a group of 20 European countries that all use the euro as their currency. The idea behind it was to simplify trade, travel, and economic cooperation. The whole thing is managed by European Central Bank, that's the ECB, and includes some of the world's largest economies like Germany, France, and Italy. But the last few years haven't been easy. The Eurozone has faced one challenge after another. Energy crisis, inflation, geopolitical tensions. Let's see what's been going on. The Russian invasion of the Ukraine in 2022 was a major blow to the Eurozone. Many countries in the region were heavily dependent on Russian energy. So when gas and oil supplies were disrupted, energy prices skyrocketed. This sent inflation to record levels and both households and businesses started to feel the pinch. Inflation has now eased to ECB's target level of 2%. However, not all countries in the Eurozone are experiencing the same trend. While some, like Slovenia and Ireland, have seen barely any inflation growth, others, such as Romania and Estonia, are still grappling with inflation rates well above 4%. Inflation isn't the only issue weighing on Eurozone. Trade imbalances have added to the problems. The war disrupted supplies of critical minerals like metals and grains from Ukraine and Russia, throwing industries off balance and driving up costs. The conflict has led to millions of refugees seeking safety in Europe, putting additional pressure on public services and government budgets. Over the past 7 quarters, economic growth in the Eurozone has been almost stagnant, highlighting just how deeply these challenges have impacted the region. The International Monetary Fund, IMF, in its latest outlook projects that advanced economies in Europe will grow by only 1% in 2024 and 1.4% in 2025. These figures are not only lower than its April forecasts, but also lag behind the growth expectation for other advanced economies worldwide. The services sector has been a rare bright spot though, managing to grow despite all the challenges. Consumer spending on services like dining, travel, and entertainment has provided much needed support to the economy. However, the story is quite different for industrial production. You see, factories have been struggling due to weak demand for goods both within Europe and in international markets. We can see these struggles reflected in Eurozone's largest economies, Germany, France, and Italy. Germany, for instance, stands out because of its heavy reliance on manufacturing. The country is facing double hit of weak global demand and stubbornly high energy costs, challenges we've already touched upon earlier. As a result, Germany's GDP is expected to shrink by 0.1% in 2024 before staging a modest recovery of 0.7% in 2025. In Germany, major industries like automotive and machinery are facing reduced orders, particularly from China. While energy prices have eased since 2022, they remain high enough to weigh heavily on Germany's energy-intensive sectors. Adding to the challenge, elevated borrowing costs and ongoing uncertainty are keeping private investments on hold. Germany's sluggish recovery isn't just a domestic issue. It's spilling over to its neighbors in Central and Eastern Europe, which rely heavily on German trade and investment to drive their economies. France, on the other hand, presents a more balanced story. You see, its GDP is projected to grow by 1.1% in 2024, buoyed by a robust services sector, particularly tourism, dining, and leisure. However, inflation in services sector remain a pressing concern, largely driven by rising labor costs. That said, challenges remain. Businesses are still hesitant to invest, and although consumer spending is on the mend, it remains cautious, reflecting lingering economic uncertainties. Italy's economy is also on a slow recovery path. With GDP expected to grow by 0.7% in 2024 and 1% in 2025, tourism is a vital pillar of Italy's economy. It has made a strong comeback, while government investments in infrastructure and renewable energy are providing some much-needed momentum. However, significant challenges still persist. Italy continues to grapple with a staggering public debt level of over 141% of GDP, which limits its fiscal flexibility. On top of that, structural inefficiencies and sluggish innovation continues to hinder competitiveness, making it harder for the economy to fully regain its footing. Circling back to broader European economy, private investments, a critical driver of recovery, have been disappointingly low. You see, despite some improvement in financial conditions, businesses remain cautious. This hesitation is largely driven by ongoing uncertainty about global economic outlook and persistent geopolitical tensions. Europe also faces deeper long-term challenges, one of the most pressing being its productivity gap with the United States. To put it simply, European businesses lag behind their American counterparts in efficiency and innovation, which limits their global competitiveness. One reason for this productivity gap is Europe's fragmented markets. Unlike the United States, where the businesses can scale quickly across a vast unified market, European firms must navigate different rules and systems in each country. This fragmentation makes it significantly harder for businesses to grow efficiently and capitalize on economies of scale. Another challenge is Europe's underdeveloped capital markets. In the US, businesses, especially startups, have access to a wide range of funding options, such as venture capital and public markets. In contrast, European firms often face limited avenues for raising capital, which hampers both innovation and growth. Demographics are another factor at play. Europe's population is aging and birth rates remain low, leading to fewer young workers entering the labor force. This is creating a serious skilled labor shortages across many industries. Adding to the challenge, labor mobility in Europe is relatively limited compared to the US, making it harder to establish innovation hubs where talent can cluster and drive economic growth. Another significant risk Europe faces is the potential imposition of tariffs by the United States, as proposed by the President-elect Donald Trump. Given Europe's heavy reliance on trade, such tariffs could have substantial adverse effects on its economy. To provide more context, Europe has increasingly relied on exports to the US. Between 2021 and August 2024, the European Union's export to US grew by 31.1%, while exports to China and Russia dropped by 19.2%. If Trump's proposed tariffs on European goods are implemented, the Eurozone could face significant economic fallout, with GDP growth potentially reducing by 0.9% according to a Goldman Sachs report. To sum it all up, the Eurozone is navigating a mix of short-term challenges and deep-rooted structural issues. Inflation may be easing, but uneven economic recovery, weak private investment, and trade imbalances continue to weigh on the region. While the services sector has been a rare bright spot, industries like manufacturing and energy-intensive sectors remain under strain. Long-term issues such as fragmented markets, underdeveloped capital markets, and an aging population further highlight the region's struggle to compete globally. External risks, including proposed US tariffs, add another layer of uncertainty to an already struggling region. That's it from us today. Thank you for watching. If you have any feedback on where we can improve, please do let us know in the comments. I'm your host Kashish, and I'll see you in the next one.